Welcome back. Earlier today was reported construction spending rose 0.3% versus the prior negative 0.3%. That was a prior month. Total private construction up 0.3. Total public construction up 0.2. There are different components to the construction industry. The blue area chart is total construction. These are across all components. The red line is the S&P 500. Total construction has been chugging higher, but lately we can see it's really kind of topped out. We have not made a higher high in several months now, actually going back to October of last year, while the S&P 500, we know, is up one day, down the next, not really any kind of strong trend at all. We see here residential construction is in red. The green line is non-residential construction, and then the blue area chart is the S&P 500. The residential construction, which arguably has a stronger correlation to the U.S. economy, has not been faring well. Non-residential construction has been stronger, but not really even that great also, kind of topping out at the moment. Here's residential construction in blue versus the S&P 500 in red. There's actually a pretty strong correlation here. We can see we hit significant highs the end of 2021, early 2022. There's a little bit of a delay, but then we see a high of April 2022 for residential construction. Both have been trending slightly to the downside. Here's the lack of correlation between non-residential construction and the S&P 500. It continues to go higher. Here's the irony. The stronger part of the construction industry is non-residential, but that has less of a correlation to the S&P 500. So we're not really benefiting in terms of the stock market. We're not benefiting from wherever there's strength in the construction sector. Here's commercial construction, has been very strong, now pulling back, and I think this is a cause for some concern in the sense that commercial construction has been one of the strongest components of the construction industry. And over the past couple of months, that has not been doing very well. Here's highway construction making new highs, but again, a very weak correlation to the S&P 500. Healthcare construction making new highs, but not a strong correlation to the stock market. Manufacturing construction, it's the same kind of story. Here's office construction, again making a double top over here, whereas the S&P 500 is really caught in a trading range. Lodging construction has been very weak. This, we know, was hit very hard as a result of the pandemic. It has come back quite a bit off of the lows September, October of 2021, but lately has not made a higher high in several months. Power construction actually has a pretty strong correlation to the stock market. We can see made significant highs, not the highest highs, but we can see made a very big low August of 2022, and so did the S&P 500, actually October. But the same type of pattern emerges. Actually kind of interesting how similar those charts are. Here's transportation construction, just made new highs a couple months ago, but now not so much. Now these are the different components of the construction industry. The red line is manufacturing construction. Arguably that has been the strongest component of the overall construction industry. Lodging is the green line all the way at the bottom. That represents the hotels, the hospitality sector, which was hurt very, very much during the shutdowns a couple of years ago. It's come back, but that only looks good coming from the bottom. It still is by far the weakest industry. The orange line is highway and street construction. There's a lot of government spending that goes to benefit this sector. But overall, if you take away manufacturing, no, the light blue line, that's office construction, but that's not, well, that's a dark blue line. Commercial construction, office construction as well. There's a lot of this industry that is not faring very well. Here's a monthly change. Month-over-month change in construction. The biggest winner by far is manufacturing construction, up 4.58%. The biggest loser has been transportation sector, and everything else is virtually unchanged. We want to show this. There's not really a lot to see lately in terms of the monthly percentage change, But we like to show this because there are different stocks and different industries that either benefit or may not benefit, depending on, what sector, what component of the construction sector is doing well. So, for example, if we own stocks in the manufacturing sector, that has been faring better. Maybe that bodes well for our individual investments. This is the yearly percentage change, the manufacturing sector, which again, month over month has been the strongest as well. That's up 62%. Lodging is up 38%, but remember, that's the hospitality sector. It's up 38%, but after really going down a lot. So, that's still not a lot to write home about. Here are the correlations between the different construction sectors, or the different slices within the industry. We can see here, for example, this is very interesting, the highway sector. Highway construction is a 93% correlation to the manufacturing sector, also to the transportation. And that really does make sense. I mean, if there's investment money put into transportation, it'll benefit the highways and vice versa. Power sector also has a very strong correlation to the transportation as well. We would likely expect there to be strong correlations, except, for example, residential. Notice that a lot of the sectors that have been doing well, residential construction, which really I think is most closely correlated to the stock market, has not been faring very well. This only has a 19% correlation to the lodging industry, which has fared a lot better. It seems like the housing market, which over the past couple of years has been very strong, is really not doing very well at all. This represents the yearly performance of the different slices within the construction industry. Now, 2023, this is where we are now. This obviously averages only what we've seen so far in 2023. The bright spot, no surprise, manufacturing. The biggest losers, residential, also commercial as well. We've been reading a lot lately. There's a lot that has been written about commercial real estates. And how that has not been faring well at all. Interesting. Take a look at what lodging did the past couple of years. 2020 down 30%. 2021 down 32%. Yes, it bounced back a lot, but now really zero. It has not followed through at all. 2019, the power sector of construction was very strong, but since then has not gained any kind of steam at all. Commercial construction looks like it bounced back after 2020. It was actually only down 2% in 2020, 14% 21, 22% 22. Nothing so far. So really, I think the takeaway from this is that the slice of the construction industry that is most closely correlated to the stock market, which we most directly would benefit from a stock investment, most likely is residential construction, home builders, things of that nature, and to a lesser extent, commercial construction. That seems to be some of the weakest parts of this overall industry. Now, I think it is very important also to spend just a little bit of time with U.S. Treasuries. I know we talk about the bond market a lot. I don't want this to be an only bond market discussion here, but there has been some really wild moves. Now, this is where the current Treasury sit, 5.27 on the 3-month. I seem to recall the 4-month did offer the higher yield very recently. The 1-month was very weak. It's still weak, but it's come back to a 4.49. Still much higher than the 3.59 10-year bond. Now, earlier today, I saw as much as 130 basis point spread between the 10-year and the 1-year. The 1-year's at a 486, the 10 years at a 359. That's 127 basis point spread, meaning that the 1 year is 1.27% more than the 10-year. It's a massive inverted bond market. This is what has happened over the past 1 month. Down 1% on the 1-month T-bills. Everything else, it's been up around 7-8% across the board. Very equally spread. But again, remember, the 1 year has been a lot stronger. And that really is a barometer that, we look at the 2-year versus a 10-year as well. But I think the 1-10 spread is really the most commonly watched. This is what the bond market looks like over the past month. The blue histogram bars, that's the S&P 500. Nothing really to tell here. The black dotted line's a 1-month T-bill. Was really hurt hard. Came down to a 336. That was April 21st, about 10 days ago or so. And now has recovered. The dark red line at the bottom is the 10-year. The 1 year is the purple dotted line, and we can see it's actually even drifting away a little. This is what the 110 spread looks like right now, and this is why it's so important. Take a look at the histogram bar at the bottom. That shows us the degree of the inversion. We're more separated now between the 1 year, the red line, and the 10-year, the black line, except for April 28th, just a few days ago. This is the deepest the spread has been this entire time. Now, we can say that we know for sure that every recession has been predated by an inverted bond market. The fact that it's widening so much, we can venture different educated guesses. We could say that the bond market, the long-term forecast, the bond market is forecasting the long-term, that's the 10-year, the black line, that, we see interest rates lower than where they are now. Obviously, if we see interest rates lower, that's for a reason, because the bond market forecasts poor economic conditions. And then the 1 year, which continues to rise, it shows us that at least in the interim, maybe the bond market expects higher interest rates. Last week, we had durable goods, which shows the price for long-term, machinery, buy for the long-term, washing machines, things like that. That was strong, but only because of a large order from Boeing. Aside from that, washing machines, automobiles, those sales were down. Durable goods was not good. The gross domestic product was released last week. It was soft. I think 0.1%. We spoke about it here last week. The PCE, personal consumption expenditure, inflation, continues to rise. Well, we know when inflation rises, the Federal Reserve has more ammunition, more justification to raise interest rates. For this reason, I think that's why we see the red line going up and the black line going down. Because what's good now, I don't want to say good, but what is positive for short-term bonds is a negative for long-term bonds. The anticipation of higher rates in the near-term future is sending the 1 year yield up. The anticipation for interest rates to go up is sending the long-term down. The higher the rates are, the more it's going to slow growth in the housing sector, in durable goods, and manufacturing, residential construction that we just spoke about, commercial construction we just spoke about. So I think we're really kind of caught in a difficult spot here, because the inflationary numbers go up as the growth numbers soften. And that is why we're seeing such a widening in the 110 spread, which is exactly what we're looking at now. This is what the bond market looked like in the year 2000. The 10-year is the black line, the red line is a 1 year. But go back to the left-hand side of the chart. This is the red year, the 1 year, the red line was above the black line. That's when the bond market was inverted. But here's the scary part. It was only a 50 basis point inversion, half of 1%. Right now, we have a 1.3%, 130 basis points versus 50 basis points, a much, much deeper spread. This is 2007. We had the 1 year, this is March 607, it was at a 492. The 10 years at a 453, 50 basis point. Half of 1% inversion. Now, eventually, if we're looking for the signal is for the 1 year to go down faster than the 10 year. Well, even faster than the 1 year might be the 1 month, and this is why we paid so much attention to this a couple weeks ago. The black line, the 1 month T-bill, collapsed. When the 1 month goes down, oftentimes a 1 year follows. Now, we do have a revival in the 1 month T-bill, and I think that's a reaction to a strong PCE in parts, which is leading us to believe the Federal Reserve may not be done. But that's also, again, the reason why we think that the 10 year is going down as well. Very, very interesting times. I think it's important for us to be aware of the movements in the bond market, because just to look at the stock market, everybody's talking about the bank failures and things like that, and that's not inconsequential, but there's much, much more of a story here. So we have more economic numbers this week, and of course we have jobs numbers coming up too, and that is always very, very interesting. So we will revisit these charts and the big economic calendar coming up as well. We hope this has been helpful. We look forward to seeing you back soon.